Welcome to this complete guide on understanding and improving your credit score in 2025. Whether you're trying to buy your first car, get approved for a mortgage, apply for a credit card, or simply understand how lenders see you, your credit score plays a major role in your financial life. In this video, we're diving deep into what a credit score really is, how it's calculated, what affects it, and most importantly, how you can start improving it right now. Grab a notebook, because by the end of this video, you'll have a clear plan to take your credit score to the next level, fast. Let's start with the basics. What exactly is a credit score? A credit score is a three-digit number that represents your creditworthiness, or in simpler words, how likely you are to pay back borrowed money. It's a quick summary of your entire financial history, expressed in a number between 300 and 850. The higher the number, the better your credit looks to lenders. Most people fall somewhere between 600 and 750, but anything above 800 is considered excellent. A strong credit score doesn't just make borrowing easier, it makes life cheaper. You'll get lower interest rates on loans, higher credit limits, better rental approval chances, and sometimes even discounts on insurance. Now, your credit score isn't just a random number, it's based on several key factors that work together. These are payment history, credit utilization, length of credit history, new credit, and credit mix. Let's break these down one by one, because understanding them is the foundation of building great credit. The first and most important factor is payment history. This makes up about 35% of your credit score. Lenders want to know, do you pay your bills on time? Even one late payment can hurt your score, especially if it's more than 30 days overdue. Every time you pay your bills on time, whether it's a credit card, loan, or even utilities that report to credit bureaus, you're proving that you're responsible. So if you take one thing from this section, it's this: never miss a payment. Set reminders, automate bills, or use calendar alerts. On-time payments are the single most powerful way to build and maintain a good credit score. The second major factor is credit utilization, which makes up about 30% of your score. Credit utilization simply means how much of your available credit you're currently using. For example, if you have a credit card with a $10,000 limit and you've used $3,000, your utilization rate is 30%. Experts recommend keeping it below 30%, but if you want an excellent score, aim for below 10%. High utilization tells lenders that you might be relying too much on credit, which can make you seem like a risk. You can improve this by paying down balances more often or asking for higher credit limits, but be careful not to spend more just because your limit increased. The third factor is the length of your credit history, which accounts for around 15% of your score. The longer you've been using credit responsibly, the better. Lenders love consistency and experience. That's why you should never close your oldest credit card, even if you don't use it often. It contributes to the average age of your accounts. If you're new to credit, time is your friend. Keep accounts open, use them wisely, and let your credit history grow naturally. Next, we have new credit inquiries, which make up about 10% of your score. Every time you apply for a new credit card or loan, the lender checks your credit. That's called a hard inquiry. Too many hard inquiries in a short time can signal that you're desperate for credit, which can temporarily lower your score. Space out your applications, and only apply for credit when you really need it. Soft inquiries, like checking your own score, don't affect your credit, so feel free to monitor your score regularly. The fifth factor is credit mix, also about 10% of your score. Lenders like to see that you can manage different types of credit responsibly, for example, credit cards, auto loans, student loans, or mortgages. You don't need all of them, but having a mix shows that you can handle various forms of debt. If you've only ever used credit cards, taking out a small installment loan and managing it responsibly can slightly boost your score over time. Now that you understand the 5 major factors, let's talk about how to boost your credit score fast, especially if it's currently below average. The first step is to check your credit report. You can get a free copy from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, at annualcreditreport.com. Go through your reports carefully and look for errors. Believe it or not, 1 in 5 people have mistakes on their credit report that drag their score down. If you see anything incorrect, dispute it immediately. It's your right to have false information removed, and doing so can raise your score quickly. Once your report is accurate, focus on building positive credit behavior. The simplest habit? Always pay on time. Set up autopay for every bill you can. Even one missed payment can stay on your report for up to 7 years, so consistency is key. If you're struggling to make payments, call your lender. Sometimes they can work out a payment plan before it gets reported as late. You can also use credit builder loans or apps that report rent and utility payments to credit bureaus. These tools are great for people with limited credit history because they create positive payment data. Another strategy is to become an authorized user on someone else's credit card, ideally, a family member or friend with excellent credit. When they make on-time payments, it also benefits your report. Just make sure they have a strong history and low utilization, otherwise, it could hurt you instead of helping. Next, tackle your credit utilization. Try paying your credit card balance before the statement date, not just the due date. This keeps your reported balance lower, which helps your score. If your cards are maxed out, focus on paying them down gradually. You can also ask your credit card company to increase your limit, just make sure not to increase your spending. Now let's discuss what damages your credit score most. Late payments, high utilization, and collections are the big three. Missing payments is the fastest way to tank your score. High credit card balances signal risk. Collections and charge-offs can drop your score by over 100 points. The good news is, even these negative marks fade over time. The older they get, the less they matter. Focus on positive habits going forward. In 2025, credit scoring is becoming more modern. Lenders are using new models like FICO 10T and VantageScore 4.0, which analyze trends over time rather than just a snapshot. That means consistent good behavior matters more than ever. Paying your bills on time every month and keeping your balances low will help you even more under these new systems. You can also use credit builder loans or apps that report rent and utility payments to credit bureaus. These tools are great for people with limited credit history because they create positive payment data. Another strategy is to become an authorized user on someone else's credit card, ideally, a family member or friend with excellent credit. When they make on-time payments, it also benefits your report. Just make sure they have a strong history and low utilization, otherwise, it could hurt you instead of helping. Let's look at a practical example. Imagine you have a credit score of 620, not terrible, but not great. You decide to start paying all bills on time, pay down your credit card from 70% utilization to under 20%, and stop applying for new cards. Within 6 months, your score could easily rise to 700 or higher. After a year, if you keep those habits, you could cross 750, putting you in the very good range. Once your score improves, the benefits are huge. You could save thousands of dollars on interest. A higher credit score can lower your car loan rate from 10% to 5%, or your mortgage from 7% to 6%. That difference could mean saving over $100 a month, or tens of thousands over the life of the loan. That's why improving your credit isn't just about numbers, it's about financial freedom. Now let's wrap up with a few bonus tips to keep your credit score strong long-term. Always keep track of your total debt. Never borrow more than you can afford to repay. Don't apply for too many cards in a short time. Use budgeting tools or apps to manage your spending. And remember, your credit score doesn't define your worth. It's just a tool to help you get ahead. Another tip is to avoid closing old accounts. When you close a card, you lose both the available credit and the account age, which can lower your score. Keep your oldest cards open, even if you only use them occasionally. If you're building or rebuilding credit, consider using a secured credit card. This type of card requires a deposit, usually between $200 and $500, which acts as your credit limit. Use it responsibly and pay it off each month, and over time, your score will grow. After 6 months to a year, you can usually upgrade to a regular unsecured card. Improving your credit score is not about quick fixes, it's about building trust over time. But with patience and smart habits, anyone can do it. So start today. Check your report, pay on time, reduce debt, and use credit wisely. In a few months, you'll see your hard work pay off, literally. If you found this video helpful, hit like, subscribe, and share it with someone who's trying to improve their credit score. And tell me in the comments what your goal is for 2025. Maybe we'll feature your story in a future video.